Hey, how's it going, everyone? My name is Amos, and today we're going to be looking at Lam Research Corporation. This is a lesser known player in the semiconductor field that has a huge economic moat because of what they do. And Lam, as you can see on your screen right now, year to date, they are up by 1.6%, which means they are hovering around their 52-week low of $67 a share, which I think they hit at around, I don't know, was it? Oh, I guess it was over here back in January of last year. And they are flirting with those numbers again, but it seems like every single time they hit around 74, 73, $72 a share, they bounce back up, which means maybe the next low is going to be 71 and then 70. So I'm trying to figure out, is it a good or a bad time to jump in? And if it's even undervalued, maybe it's bouncing to these low levels because it's overvalued. So in this video, we are going to be looking at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. And this is a YouTube channel that is focused around dividend compounders or trying to find them, right? So the first thing that we're going to be doing is looking at their dividend profile. Their dividend yield is a 1.1%. Nothing to write home about. Meaning, for each share of Lam that you own at $76 a share, you're going to be looking at roughly 92 cents a year in dividends. However, the redeeming factor is that their dividend payout ratio is 25%, which tells me on surface level that this dividend is absolutely sustainable and there's room for further growth. And speaking of growth, for the past 5 years, the growth rate is sitting at 13.5% year over year. And Lam has been growing this dividend for the past 9 years. So far, so good. And the next thing that I like to look at is the adjusted stock price total return to figure out if it's even worth our time. We look at their history and we find out that we would have lost money by investing into them, then it tells me that it's not worth our time to analyze and research this company, and we can stop the video right there. But anyways, year to date, yeah, things aren't looking too good. But if we zoom out to, let's say, I don't know, 5 years, if we zoom out to 5 years, then you're looking at a return of 199%, which is respectable with a capital R. What about 10 years? 10 years out, then you're looking at 1,000% total return, which I like to see that. And if we do 20 years, then the total return is 3,300%. So that gives us the green light to continue this investigation to figure out if Lam is undervalued right now or if they're going to be going through a further dip. So Lam Research Corporation was founded in 1980 by David Lam. And if that last name sounds Asian, it's because yes, he was Chinese American, and at the time he was an employee at HP, and then he had the bright idea of like, hey, knowing what I know now, I could probably go and start my own company and make a gamble on myself, and I'll probably be rich. And rich did he become. And since then, the company has evolved many times. But Lam Research has kept true to its DNA of being an innovative leader in semiconductor technology. Because even in 1980, Lam Research were game changers in the semiconductor space. And one thing that I love about this company is that they just do not let their foot off the gas after a successful breakthrough like most companies do. They just play it safe like idiots. Instead, Lam Research is continuously pursuing R&D, research and development, to stay at the top of their game, to be best in class. For instance, during the Great Recession in 2009, instead of cutting costs in developing new technology, the cool thing is the leadership team doubled down on innovations, and that bet paid off. And the reason why I tell that story is because I like a company that has events like that happening in their history, which means we can kind of predict what they're gonna do when their backs are against the wall or when they have the sudden urge to go number 2 during their morning run. We know they're gonna be sprinting to the end. And instead of hopping a squat to drop a deuce and blaming it on the neighbor's dog, they're gonna just run all the way home and take that risk, that gamble. I love companies that do that. Because what I'm trying to say is I hate when companies play it way too safe, aka Intel, and allow the competition to catch up or to even overthrow them to the point where they become irrelevant, and then they have to scramble around to redefine themselves and become a company that is constantly panicking. Like, that's not the way to go. And that's why, even though I don't like Amazon for how they treat their workers, I really like Amazon because in their DNA, they have this motto, this quote that goes day one, meaning you're going to treat every single day that you go into into the office or into the warehouse or into the laboratory as if it's day one, to have these risky ideas, to ask the right questions, and to constantly be looking at things with a continuous improvement lens. Circling back to Lam Research, as of today, their most important offerings are the etch and deposition tech in semiconductor chips. I'm not even going to pretend like I know what that is, but I will just show it to you on your screen right now. Apparently, when it comes to etch and semiconductor chips, Lam is best in class. They have a huge economic moat because they're the only ones that can do this and do it well. And I guess on a high level, etch is what allows semiconductor chips to have certain technologies within it. So this is the etch that they have, and then they also have deposition. And they are not the only ones who do this, okay? But deposition, they are second in class, and it is still a sizable market share. And that's pretty much like the equipment and manufacturing that you see on your screen right there. And if all of this semiconductor chip talk is confusing you, like that one time your best friend took his shirt off and you saw his abs and then your little ding dong started moving, if you're confused like that, then let me explain it and break it down like this. Think of a semiconductor chip, like what you see on your screen right now, kind of like a salad. Right? When you think of a salad, there's so many different ingredients and moving parts that make a salad, right? There's the bowl itself, the vegetables, the dressing, and whatnot. So in the lens of a salad, let's think of Samsung as the company that is providing the blueprint and the recipe. Like, this is what we want to manufacture, this type of salad. And companies like Lam are the ones that are going to be providing the knife, the mixing bowl, and shredded cheese grater. In fact, Lam is probably the one that puts a healthy dose of honey mustard and ranch dressing into the salad as well. And we can think of TSM, the one that puts it all together, as the guy that prepares the salad for the customer by utilizing the tools and equipment that's given by Lam Research. So if you're following along with that example, TSM is also going to be the guy that is providing the ingredients such as lettuce, tomatoes, pineapple, baking bits, and butthole sweat. And I'm not even going to pretend like I'm a semiconductor engineer, but when I looked into it, that was the best way that I could understand it and how I can explain it to someone else. One thing that I have learned as a business leader is that if you cannot explain a concept, a theory, a process, or a service to someone else, that means you truly don't understand it. And I think with my salad example that I made up in my head, I think it makes sense. At least it does to me. So Lam is in the business of giving the technology and tools that companies need in order to manufacture semiconductor chips. Does that make sense? Like what you see on your screen right now, enabling chip makers to create the future. That's what Lam essentially does. So in the semiconductor chip manufacturing process, Lam is the one that is providing the manufacturing equipment and the high-tech tools that the company needs. And more specifically, their economic moat is around the wafer fabrication equipment. And from my limited understanding of the semiconductor space, no one else can do what Lam does. Actually, that's a lie, because I alluded to it earlier. They're second in class for the deposition, and best in class is actually Applied Materials, which is another publicly traded company. But when it comes to the etch technology, yes, Lam Research is the best. But you get my point. Don't try to be a wise guy with small feet with me, okay? Let's move on to the next thing. Now, the next metric that we are going to consider is the free cash flow to figure out, is this company cash heavy or are they burning through cash? So as we look at, 2009, they posted negative $122 million of free cash flow. Well, we'll give them a pass on that. That was the Great Recession. And as we fast forward, I am starting to see a trend and a pattern where sometimes they go up and sometimes they go down, and that's the cyclical nature of semiconductor chips. But for the most part, they are going in the right direction. And as of this past year, they posted $4.2 billion of free cash flow. So all in all, I would say they get a green light on the free cash flow. And when we look at the numbers itself, it seems like Lam finds a way to always double their free cash flow every couple of years. Although if you are seeing what I'm seeing, in 2023, they posted $4.6 billion, but the free cash flow went down by $400 million. But I don't think that's too concerning, because in the next year or so, it'll probably go up to a new high based on their historical trend and pattern. Now, the next metric is going to be their revenue, which is the top line, which is really important. If a company's revenue is declining year over year, then you know the company is in big trouble. But anyways, when we look at their revenue for the past 15 years, it is looking good. It is going in the right direction. And as you can see, the cyclical nature of semiconductor chips, sometimes it goes down and then it goes back up. Sometimes it goes down and then it goes back up. So based on the numbers, we are in that upswing and rebound right now. It's because every single time that Lam Research goes on a dip, it reaches a new high in a few years, without a doubt. That's what happens every single time. So their new high was around $19 billion, and then they started going on a slow decline and a dip, and now they're back in the upswing. So if I were to guess, I would say their next new high revenue is probably going to be around what, $22 billion? Because that's exactly what happened in 2018, and it happened again in 2022. So probably in around what, 2026, if we were to just go based off of patterns. This is just monkeys looking at numbers, right? We can't really predict the future, but based on their past, it's just something that I'm throwing in the air and hoping that it happens. And one thing that I want to throw out there before I forget, from my research and listening to their earnings calls, Lam Research is a cash-heavy company with a mission to return at least 75% of their free cash flow back to the shareholders in the form of dividends and share buybacks. And as we saw on the last screen, they're posting billions of dollars in free cash flow. So if you prefer a company that prioritizes the shareholders, Lam Research seems to be that type of company. And last but not least, we are now going to be looking at their historical PE ratio to see if they are overvalued according to their past trading valuations. And as you can see on your screen right now, in the early 2010s, they were trading at a single digit. And this is before the whole AI wave, because during this time, even Nvidia was struggling. And as we fast forward throughout the years, except this is an outlier, we're not going to be looking at that. They traded around like a 19, a 12, my goodness, you would think that we're talking about a CPG company like General Mills or oil and gas company, but this is a semiconductor equipment company. This is weird. As we fast forward, now they're trading, what, 36 in this past year, but now they're back down to a 25. So all things considered, I think right now they're fairly valued, and especially when you look at their past history. So how exactly does Lam Research make revenue? Well, if you don't get it by now, Lam sells the specialized chip making equipment to companies, and then they offer services for a fee like maintenance and upgrades. And their customer base is really concentrated. It's not like 100 different vendors and procurement teams they're working with. We're talking about Intel, Samsung, Micron, and TSM. That's it. That's literally their customer base. The machines and tools that they sell to these four companies, they cost about $1 million each. And Lam's equipment has a lifespan of about a few decades, according to their website, 20 to 50 years. Then again, when you think about it, the technology that is used to create a semiconductor chip, it's evolving so rapidly that companies are not going to want to keep the same equipment for 40, 50 years. Does that make sense? These companies are going to want to replace their parts when the new stuff comes out, which means another $1 million going into the wallets of Lam Research. And because they only have a few customers, the relationship side of the coin is going to be really important for their success in the future. If you piss your client off enough, they're just going to go ahead and spend billions of dollars to replace you in the equation. I mean, look at what happened with Intel and Apple maybe like 8 years ago or so. All of Apple's MacBooks were supplied with Intel chips. And then Apple realized, like, dude, Intel is making a substandard product. I'm going to have to just do it myself and create an M-series chips that's even better than AMD and Intel. So that's something to just keep in mind. And not too long ago, Lam Research posted their 2025 Q1 earnings. And let me tell you right now, it was beautiful. The analysts expected an estimated EPS of 81 cents a share. Instead, Lam Research posted 86 cents a share, meaning they beat the analyst estimations. And for the revenue, the exact same story. Wall Street expected $4 billion, but instead, Lam Research posted $4.1 billion. The company is doing hot right now due to the AI wave. Their sales went up by 20% year over year compared to the quarter of last year. And I think when you look at it from a 12-month timeline, it went up by 8%, which is still respectable. And something else that happened very recently, back in October, they had a 10-for-1 stock split, and they authorized a $10 billion share buyback. If you don't know, companies generally do this when they think and see that their stock is cheap. So if you think your company is undervalued, you're going to be shelling out money to buy back those shares at a very cheap valuation to artificially pump the stock price. Off the top of my head, Altria is doing the exact same thing right now. And Lam's forecast and guidance for the future is optimistic. And with that said, now we made it to my most favorite part of the video. Looking at the intangibles, looking at everything else is cute and everything, but the numbers don't lie. And that's what we're about to do right now. We're going to be calculating an intrinsic value based off of some valuation models. By looking and crunching their numbers, we're going to figure out how much is this stock worth and is Lam Research undervalued. The first one is going to be the multiples valuation. Essentially, we're going to figure out a market-derived price based on how Wall Street looks at their competitors. With that said, the median PE ratio of the semiconductor space of people doing the same stuff that they're doing is around a 30. And I think their PE ratio right now is sitting at a 24.6. So even among their peers, Lam Research is slightly undervalued. But let's go ahead and bounce back to the multiples valuation to see what the price is going to be. And that is $94 a share if they were priced according to the market valuation of their peers. Moving right along is going to be the discounted cash flow analysis model. As we learned earlier, their free cash flow is looking okay. Sometimes it goes up, sometimes it goes down, but overall it's going in the right trend, and that's what we want to see, which is increasing and growing every few years or so, and that seems to be the case with Lam. The average growth rate year over year is 23.5%. We're going to shave that down a little bit just to be cautious and say 15% instead, meaning I'm going to plug into the equation that their free cash flow is going to grow at a rate of 15% year over year. And when we take that into consideration with some balance sheet numbers, and by the way, their total debt is not a bad picture. They have $4.9 billion of total debt, and their cash and cash equivalents on hand is $6 billion. And remember, their free cash flow is also around $4 billion. So they could effectively eliminate their total debt in about a year or so if they really had to. However, one call out that I do have is they do have a lot of shares outstanding at about 1.2 billion shares. Anyways, with all that said, the DCF price for Lam is going to be $119 a share. The next one is going to be the dividend discount model. Essentially, their dividend and the growth thereof is going to tell us an intrinsic value for Lam. And as we can see during the pandemic, not only did they pay a dividend, but they chose to increase that dividend, right? It went from 12 cents every 3 months. Now you get 23 cents every 3 months. I know it sounds like small change, but remember, they just had a 10-for-1 stock split. But anyways, the average growth rate is 19% for their dividend for the past 5 years. That's a little too optimistic for my taste. So instead, we're going to say, hey, they're going to be able to afford to grow their dividend at 7% year over year, and that's a very bearish outlook. So the DDM price for Lam with a 7% dividend growth rate is going to be $98.44 a share. If I were to say something like, I don't know, 7.5%, then it would have been $197 a share. And that's why I'm going a little careful here and saying 7%. And last but not least, we have Benny Graham's valuation model. Essentially, their growth rate projection and the current AAA corporate bonds yield rate is going to tell us how much this company is worth. All that said, $69.57, which right now they're around that number. I think that might be their 52-week low. So Benny Graham might not be too far off there, which brings us to the conclusion. How much is Lam Research Corporation actually worth when we take all four of these numbers into consideration? We don't want to just look at one, because then it might give us too much of an optimistic taste, and we don't want to just look at the lowest number, because then we might be way off, right? But when we take all of these into consideration, then we see a more complete picture. So the intrinsic value for Lam is going to be $95.33 a share. As a reminder, they're currently trading for about $75, $76 a share, depending on when you watch this video. And now we want to compare that number of $95 to what the Wall Street analysts believe that Lam is worth. Wall Street believes that Lam is worth $95.79 a share with a low estimation of $76 a share, which is what they're currently trading for right now, and a high estimation of $120. This dude is he's too much. So we said 95, Wall Street says 95. So I think we are seeing eye to eye here, or as I like to say, nipple to nipple. So with all that said, now I want to figure out what is an acceptable buy price to buy into Lam Research, because I don't want to be a sucker that overpays for a company, right? I like to buy things on discount. A high quality company on discount is one of my most favorite things in this world. So right now we're going to say it trades for $75 with a 10% margin of safety baked in. Then I'm looking at buying into this company when it trades at about $85 a share. However, right now it's trading for $75, which means there's a discount of $10. And if I were to buy into Lam Research right now, I essentially get a 21% margin of safety. Meaning, over the next 52 weeks, if I were to buy right now, I can pretty much guarantee with a gambler's code of honor that I'm gonna at least get a 21% rate of return in the next 365 days. That's what it's basically talking about. So what is my opinion and personal plan when it comes to Lam Research? Well, to answer that, I think the bigger question here is, when we think about their customers, who is buying this technology and equipment and tools from Lam, will the customers buy more or less from Lam as we go into 2025 and 2026? And as a reminder, Lam is not selling their products and tools to regular Joes like you and me. We can't just hop on Amazon and buy something from Lam. Lam is selling it to the biggest brands and chip makers around the world. They're selling it to Intel, Samsung, TSM, and Micron. So I bring that up because if you feel bullish about those companies and what they are doing right now, then Lam is an indirect play to their economic success. What I mean by indirect is, if you feel like Amazon is overvalued, but you want to ride the wave of Amazon's e-commerce domination, then what I would do is buy into a cardboard packaging company like WestRock. That's what I mean by indirect. So here's what I think. As we go forward, will chips be more prominent and in demand? Or is semiconductor chips a technology, a phase that we're just going to overcome? And to answer my own question, as a reminder, semiconductor chips are in our phones, computers, cars, cloud data centers, and every AI infrastructure. So you be the judge here, right? You can help me answer this question. I think chips are going to be more important as we go forward. However, it's worth mentioning that historically, semiconductor chips and the demand thereof has been on a cycle basis. Sometimes the demand is high and their partners and their customers are going to be buying a lot of their equipment and tools and whatever they need. And sometimes they don't need as much because the customers are peeling back from the consumer trends. And so if Samsung doesn't need your equipment that year, that means Lam is going to suffer on their top line and effectively their bottom line as well. Now, with Trump taking office in January of 2025, I think Lam is going to shift more of their production side from Asia to their existing factories in California and Oregon. By the way, these guys are worldwide manufacturing their stuff. They're not just located in one place. So when I think about supply chain issues, I think Lam is a little more resistant to that. However, when I think about them moving back to the US, I don't think they're going to stay in California because of the tax stuff, right? So most likely what I think is going to happen is Lam will build new facilities in Nevada and Texas, if we're being honest. Like, that's what happened with Tesla as well. So the potential threat of buying into Lam is not going to be the cyclical demand of chips, but I think it's going to be more so the geopolitics. Because tensions between China and the US will only get more and more weird until we figure out what's an acceptable tariff situation between the two companies. So I think the geopolitics will affect its fundamental customer base more so than the cyclical demand of chips itself. All that to say, the consumers, whether they are in the US or in Beijing, they're going to be relying on technology and chips that are made through the equipment from Lam. So what I am going to do is I'm probably going to start buying into this company when it reaches an attractive valuation. And for me, I think I'm going to be eyeballing that $71 to $72 range. No, I do not have an existing position in them, but after learning about them, I feel good. Right? I look at them the same way that I look at Skyworks Solutions. That's another semiconductor chip company that I'm eyeballing as well. I have not opened a position in that one either. Both of them, pretty good. I think they're undervalued. With that said, do not copy me and just buy into a stock just because I am. Do your own research to figure out whether or not it's a dividend compounder with cheese. Because my conclusion is this: I think lamb is a dividend compounder with cheese, and I think it's slightly undervalued. And who knows, after your own research and investigation, you might conclude that lamb is a dirty butthole, in which case, more props to you, because let me know. Maybe I'm not seeing it from a right angle, and maybe I'm just buying into this blindly. Actually, that's not true. I did my research and calculations to figure out a good price. But tell me what's wrong with Lam. If you think this is a bad company, let me know, because I think it's pretty solid. I love you, and I'll talk to you next time. Stay safe with your sweaty nipples. See ya.